6 of the largest private credit funds in America just told their investors the same thing at the same time. You cannot have your money back. Blue Owl, BlackRock, Apollo, Ares, Blackstone, Morgan Stanley. Every single one hit the 5% quarterly redemption cap in the first quarter of 2026. Investors at Blue Owl alone tried to pull $5.4 billion. They were handed a fraction and told to wait. That Reuters headline you're looking at right now, Moody's downgrading Blue Owl and slapping a negative outlook on the entire business development company sector. That landed on April 7th, 3 weeks ago. This is not a single firm having a bad quarter. This is an asset class showing cracks at every load-bearing wall. Chris MacIntosh at Capitalist Exploits flagged the structural risk in the private credit retail channel last October, months before the first gate dropped. His research this week lays out why this is not a containment story. It is an escalation story. And the part that should genuinely concern you, the part that connects this to your retirement account specifically, is something almost nobody is talking about yet. We will get there. But first, you need to understand how a $1.8 trillion market got here. Think about it like a hotel that oversold every room. On a calm Tuesday, nobody notices because half the guests cancel anyway. But on the weekend of a sold-out concert, everyone shows up at the front desk at the same time. The hotel doesn't have enough rooms. So what does it do? It controls the line. It lets 5 people in per hour. It tells the rest to wait in the lobby. And it never posts the real occupancy number on the sign out front. That is exactly how a non-traded business development company works. The withdrawal window is quarterly. The cap is 5%. The manager controls the valuation. You, the investor, cannot mark your holding to a real bid because there is no public market. Every feature of this structure is an engineering choice designed to make panic invisible. MacIntosh's Capitalist Exploits research calls this out directly. When 6 major funds hit the redemption cap simultaneously, the engineering has failed. The line at the lobby stretches around the building. Goldman Sachs, for its part, met its first quarter redemptions at 4.999% of shares, 1/1000th of a point below the gate. Feel how that lands? They avoided the gate by the width of a hair. And that margin is itself a confession. Now here is what rhymes with history, because there is a clock that started ticking in February, and the sequence it follows has appeared before. On April 2nd, 2007, a subprime lender called New Century Financial filed for bankruptcy. At the time, the industry consensus was that this was contained, an isolated blow-up in a corner of the mortgage market that serious money didn't touch. 4 months later, BNP Paribas froze 3 investment funds. 13 months after that, Lehman Brothers collapsed. The distance from New Century to Lehman was 18 months. Now look at the Morgan Stanley default rate chart on your screen. Private credit default rates have climbed from 4% to 5.8% in a single year. Some observers expect 8% as AI disruption continues to gut the software companies that are the single largest borrower concentration in private credit. That exposure to SaaS companies alone is roughly $500 billion, and here is the number that should reframe everything. The private credit market is approximately $1.8 trillion. When you count the leveraged loans, the CLOs that package them, the BDCs that sell them to retail, the insurance companies holding 8% of their assets in this paper, you are looking at something materially larger than the subprime mortgage market was in 2007. BlackRock recently wrote down a private loan from 100 cents on the dollar to zero within 3 months. Not a gradual loss discovery, a valuation that was fiction the day it was set, carried at par until the fiction became unsustainable. The Congressional Research Service has formally flagged it. Payment-in-kind loans, where borrowers pay interest by issuing more debt instead of sending cash, now account for 11% of BDC income industry-wide. When your borrowers pay you in IOUs, the word income earns its quotation marks. That is the disease beneath the symptom. But the part almost nobody is connecting to this yet involves 90 million Americans and their retirement savings. That is next. In August 2025, President Trump signed Executive Order 1-330. It is called Democratizing Access to Alternative Assets for 401k Investors. In plain language, it directs the Department of Labor to reduce the barriers that had historically kept private credit, private equity, and related alternatives out of the average American's retirement account. The proposed rule implementing the order was issued in March 2026. Comment period closes in May, expected to take effect before year end. Now take a step back and notice what is happening at the same time. The same month the largest funds in the asset class start gating redemptions on the product they have already sold to retail, the executive branch proposes a rule designed to funnel 90 million additional Americans' retirement savings into the same asset class. 90 million savers, $13.8 trillion in defined contribution plan assets. That is the proposed distribution channel for an asset class where the existing retail investors are currently being told to stand in line and wait for their money. Chris MacIntosh at Capitalist Exploits puts it in terms that cut through the noise, follow the incentives. The ruling class needed to offload their positions onto the public before the gates finished closing. The question is not whether this affects your portfolio. The question is whether you realize it already does. Because if you hold target date funds, if you have a 401k managed by any of the names I just mentioned, the plumbing is being rebuilt underneath you right now. And the people rebuilding it are the same people gating their existing investors. So what do you actually own instead? What has a real bid, a physical identity, and does not depend on a spreadsheet that 6 major funds just had to defend at the same time? There are really 2 paths from here. Path 1, the gates hold, the defaults stay manageable. The 401k channel absorbs the product, and the private credit industry muddles through for another cycle. Path 2, the escalation sequence that has rhymed across 40 years of financial history, from New Century to BNP Paribas to Lehman, continues to rhyme. Spreadsheets get tested in gates. Gates get tested in bankruptcies. Bankruptcies get tested in contagion. MacIntosh's research at Capitalist Exploits does not try to predict which path. It positions for both. And the positioning is specific. Oil and gas producers with free cash flow at current prices. Energy services companies beaten down for a decade. Gold and silver miners trading at 40-year lows relative to the S&P 500. Farmland in jurisdictions where ownership is actually yours. Look at that Tidewater vessel on your screen right now. Tidewater, ticker TDW, sits in the Capitalist Exploits portfolio as the cleanest example. A pure-play offshore service vessel operator, $710 million of debt, $263 million of free cash flow, public, traded, marketable to a real bid. The opposite of opaque, a barrel of oil is priced on whether somebody wants to buy it at the dock. A bar of gold is priced on whether somebody will hand you dollars for it. A hectare of farmland is priced on whether it grows food this year. The denominator in each case is physical. The denominator in private credit is a spreadsheet, and that spreadsheet just failed its first real test. In both scenarios, the investors who do well are the ones who saw it early, who positioned in assets with a physical identity before the crowd figured out the difference. So where do you find research that consistently identifies those assets before the move is 80% done? I told you the investors who win are the ones who see it early. This is how they see it early. Chris MacIntosh and the team at Capitalist Exploits publish the Insider newsletter twice a month. Each issue centers on what they call the Big Five, deep value trade ideas screened for the same thing every time: limited downside, massive upside, asymmetric risk-reward by design. These are not journalists guessing from the sidelines. They are fund managers and entrepreneurs who invest their own capital alongside their subscribers. They called the structural moves in energy and commodities before those trades went mainstream, and they are positioned now in the physical assets I just walked you through. This is not for people who want day trading signals or meme stocks. It is for self-directed investors who trust their own judgment, want calm evidence-based positioning, and refuse to get their financial opinions pre-approved by CNBC. Right now, paid subscribers are seeing the specific names, the entry points, and the full framework behind every position, including the ones that sit on the other side of this private credit unwind. The free tier gives you 2 macro articles a week. The paid tier is where the ideas become actionable. The annual plan is $420 a year and includes the full asymmetric investing course. The link is in the description. Do not miss the next one.